But what I've come to learn over the last 10 years is that it's really not about the money. It's money, especially in crypto, is sort of the cheapest resource that a founder can obtain.
Welcome to the latest edition of the Crypto Playbook. Today, we're going to discuss investing in crypto. I'm Jeff John Roberts, finance editor of Fortune magazine.
And I'm Leo Schwartz, a reporter at Fortune.
We're going to take a serious look at, should you choose to put your money in it, how to go about this. To be clear, this is not investment advice, as they say. So if you go and, put all your money into some like weird dog coin and lose it, it's not our fault. This is just more a guide to people. The stuff has been out there. People put money into it. Is there a rational way to do it? And, how do people go who invest in crypto? How do they do it? What are they doing? So we're just going to provide an overview of that and go keep your own counsel and don't do stupid things with your money. But well, Leo, you're the crypto skeptic on the podcast. Would you put any of your money into crypto?
I think the common advice given by even many traditional financial firms at this point is if you want to allocate a bit of your portfolio, probably just to Bitcoin, maybe Ethereum. I think it can go anywhere from 1% to 4%. That's probably not going to be the end of the world. There's always been this philosophy of having some alternative assets in your portfolio, whether that's crypto or being able to invest in private companies or even art collection. This is what very rich people do, so why not let other people do it as well? I think the question really comes, besides Bitcoin, which has been on a historic tear recently, should you really venture into these other cryptocurrencies, which certainly have less staying power and less of a clear thesis than Bitcoin, I think. What do you think, Jeff?
Yeah. And I do think, because some people, I unfortunately don't have this personality, but some people just like the rush of day trading. And I think it's a foolish idea. I'm kind of a, sort of stodgy, I suppose. My money's in Vanguard index funds, most of it, a handful of stocks I think might be good. And then I have a little bit in Bitcoin and a tiny bit in Ethereum, not very much and stuff. Also I tell my reporters too, full disclosure, to get a little bit of Ethereum because you can't really understand crypto unless you have it firsthand and use a wallet and stuff like that. But in terms of speculating, I think that's what it is. Most cases, most of these coins are new, unproven, and highly risky. Some people like, angel investors like betting on startups. 9 out of 10 startups goes bust. And it's a free country. If you want to put your money in, go for it. But I do think there's some common sense stuff you should do. Beginning with, don't put only put like 5% of your money into crypto or less. What you can lose, and the most of that put into stuff that's been around for a while. If you want to take a flyer on something new, go for it. But to be clear too, I know I'm a little more bullish on crypto. Leo's quite skeptical, but I will share his position that a lot of these are flat out scams. And I think the percentage of scams, there's scams in startups and traditional stocks too. Every day we read the SEC ring someone up for, peddling fraudulent securities in the traditional stock market world. But in crypto, I'd say it's probably even more dangerous. Leo, I'm sure you'd agree.
Yeah. And what's interesting now is it used to be that you could invest in Bitcoin or Ethereum or anything else that you wanted. You'd usually have to go to Coinbase or another exchange to do it. Now you can buy Bitcoin and Ethereum and probably soon other cryptocurrencies through ETFs on the same traditional exchanges and brokerages that you would trade anything else on. And increasingly, there are more public companies that are crypto companies, or at least exposed to crypto, like Coinbase, like Circle, which has its own stablecoin, even Galaxy, which is a conglomerate that has a venture fund and a mining operation. So even if you want exposure to crypto, investing in crypto itself is not necessarily the only way to do that.
That's true. But for years there's been these like workarounds like Grayscale's products and stuff like that where you can buy a share over here. I do think it's, I think the most efficient way to buy crypto is just to buy the crypto. You want some Bitcoin, go buy Bitcoin, figure out how to hold it. That way you're not paying someone else to kind of manage or hold it for you, but your mileage may vary. It's really not that hard. Just, go open a account on, Coinbase or Binance or Kraken and go and buy some of the stuff would be the way to do it. I don't really see the need for like the indirect bank shots, but it's true. That is a strategy to do it.
So, Jeff, who do we have today who's going to explain how to approach crypto investing?
On today's episode, we're joined by Jake Brukhman. He is one of the smartest people in crypto I know. He's a kind of a mad computer geek. Well, not mad actually, just a very smart sort of computer science technologist who worked at Amazon for a long time. So he is not fly by night by any stretch. He is CoinFund is one of the first crypto venture funds, and he's got a very impressive team around him. A guy named David Pacman, who's one of my favorite sort of crypto people. He former Apple executive who worked on Wall Street for a long time. These guys run, basically a hedge fund investing in crypto. So I'm going to probe them for how do they do it? Where do you put your money in? How do you evaluate what a good project is or not? Because there's all these goofy metrics out there on whether something's good or not. But I mean, these guys have their real money on the line. So I'm going to put it to Jake and ask him, what exactly do you do? How do you go about this? How do you invest in crypto?
Great. I'm excited to hear from him.
Jake, wonderful to see you again. Welcome to the Crypto Playbook.
Hi, Jeff. Yeah, thanks so much for having me.
As evidenced by, I'm glad to have Jake because he's sort of from CoinFund, which he founded, one of the most respectable VC firms. I know your partners. You've got, next US Marine. You've got David Pacman. One of your partners is, former Apple Music guy. And you yourself, you came from Amazon, right?
That's right. I worked in pure and traditional finance, and then pure tech as well. So my pure tech stint was at Amazon as a technical product manager. And then earlier on, I was kind of quant researcher and developer and engineer in the hedge fund space.
And I want to get into crypto investment shortly, but just tell me a little more about what attracted you to the crypto space. Was it the tech or a chance to make money or both?
I was always very, very interested in both technology and finance. Both of my parents worked on Wall Street for many years. I was intrigued by this idea of investing and exploring new asset classes. And, when I saw Bitcoin, I learned about it in 2011. I didn't really, I think, fully get it until 2013, but I thought it was, one of the most interesting, intersections and bringing together of finance and tech. And then when I read Vitalik's white paper for Ethereum in, I would say, early 2015, it really gave me this impression that this was going to be a brand new asset class. Digital assets made a lot of sense in a increasingly digital world, increasingly connected and internet-enabled world. And so I dived in head first. And actually, Jeff, this is our 10-year anniversary at CoinFund.
Tell me a little bit about, because, for readers unfamiliar, VCs didn't exist in crypto for a while. And then if they existed, they might be like one partner at a broader firm who was sort of put off in a corner because it was a little bit suspect. But, I think you must be one of the very first crypto VC firms. Now there's lots of them, but how did that come together, or just explain what a crypto VC firm does?
Absolutely. Well, my intention in creating CoinFund, other than, the desire to participate in this exciting technology industry, was to create a firm that would be more specialized to investment in this new type of not just technological organization, but also this like a new asset class, right? So when early on, we were seeing blockchains start to come to market. First we saw Bitcoin, then we saw kind of Bitcoin clones, and then eventually Ethereum and smart contract platforms. It became very, very obvious that we couldn't just be investing in the equity of these companies. We had to be investing in the native digital assets of the networks themselves. And early on, most venture capital firms were really not set up to do that, right? Their partnership agreements didn't really provision for any other kind of asset class or investments into digital assets or liquid assets. And it really was a number of years where the industry was sort of figuring out, like, are we liquid funds? Are we VC funds? Are we hybrid funds? And I think where we have come out is, at CoinFund anyway, is that we have a few programs. We have an early stage seed program where we're really investing in early stage teams that are kind of equity based, but often are also creating a token component in their products or a decentralized network that has native assets. And so we tend to invest in both of those assets when we make an investment. And then we also have a venture fund, which is a little bit later stage in that same game, usually still pre-TGE, as we say, or before the token has been launched. And finally, we have a liquid fund, which is looking more at purchasing public assets on crypto markets. So these are, bigger, more liquid things like Bitcoin and Ethereum and Solana itself.
Yeah, I think that's important to understand. I think it's obvious to, people deep in the crypto world, but it's not like traditional startup Silicon Valley where you buy something and you get part of the equity and you hope the thing goes public or gets an exit. In crypto, typically the VCs take tokens, but in the early days, in the kind of, wild ICO days, you simply could get a bunch of tokens right up front, right, and then dump them. But now there's typically guardrails and lockups. Can you sort of explain that concept and how it works for your purposes as an investor?
Yeah, I think over the years, and it's been about a decade or so, some best practices have been developed, and I would say like the middle 90% of the deals that we do sort of look like an equity component, which may or may not involve board and governance rights of the company. We find that very helpful, and especially in a post FTX, post 2022 world. I think investors have gotten a little bit more serious about company governance and board seats. But also, as I said, very often there's a token component to what the team is building. So, if, for example, if they might be building a layer 2 blockchain, which has a native token, and then, what we're purchasing in that case is usually some kind of instrument that gives us rights to a certain percentage of those tokens when they get launched, and that typically looks like a side letter or token warrant. But that's the typical setup. And I'll just say one more thing is often founders have the opportunity to make both of those assets valuable. If they're creating a network, the value capture of that network is often in the token. But in their equity business, they often also build useful services in the network that can take credit cards and provide services that look more like a traditional technology company.
Yeah, I guess that's the best bet, a win-win where it thrives as a company, but also the tokens appreciate. Just take me back to the beginning, though. What was CoinFund's very first investments? I'm going to assume Bitcoin, but if you started
2015.
2015, right? So there would have not been many games in town. I mean, Ethereum had just launched. So what were your first sort of 4 or 5 investments?
Absolutely. So, the very first fund that we had really took this position that it was more or less a token only fund. Our very early thesis was, and it turned out to be not quite not quite there, but was that like this new type of asset would sort of take over the world, and that's the only value capture mechanism that you would need to make an investment. Now, as we see, as I just mentioned, we actually have found a use for equity in terms of governance and stuff, and so it has evolved in a slightly different way. But that very first fund was looking at some of the very first blockchains. I remember when we were writing some of our first investment memos, there wasn't even a concept of a smart contract, really. That was a theory, but there wasn't a network in market that was doing it. So when we talked about these assets, we really talked about cryptocurrencies. Obviously, Bitcoin was a big component of that. There were also other cryptocurrencies in the market that started to try to do useful things. There was something like Namecoin, which was registering basically like domains. There was Litecoin, which was a Bitcoin with a slightly different purpose. But then very quickly, smart contract platforms came to market. In fact, CoinFund predates Ethereum mainnet by just 29 days. Ethereum launched on July 30th, 2015. And once that happened, the barrier to entry for a team to create a new token went from, oh, I have to fork the Bitcoin blockchain, to I can create a new token with 8 lines of code. So it became a lot cheaper to launch tokens, and the addressable market of tokens really, really grew. The number of tokens proliferated. I remember we participated in the first ICO on Ethereum, and that was a prediction market called Augur. It was a fully decentralized prediction market.
Is Augur still around?
Augur's still around, but not really. I don't think it has achieved much traction today. But the concept of prediction markets, I think, is very successful. We're seeing Polymarket predict U.S. elections, as well as Kalshi more recently making moves in that space.
Yeah, fascinating companies. I think Polymarket's raised $200 million from Peter Thiel and friends. So that's certainly a category. And you're right, Augur was an early proof of concept on the blockchain, and Polymarket relies on a blockchain too. Real quick, Jake, a couple early winners and losers for your fund from that era?
Well, look, we were certainly very, very early to the very lowest layers of blockchain technology. And in those days, those were the fundamental cryptocurrencies themselves and the early smart contract platforms. I would say Ethereum was absolutely a an integral part there. I remember CoinFund was purchasing Ethereum for 60 cents on Kraken back in 20 late 2015, early 2016. But we also were very, very interested in kind of developing uh, blockchain technology, making it faster, making it cheaper. And so we have a number of kind of alternative smart contract platforms from that era as well. We looked at, we were kind of ICO investors in uh, ICP, which was then known as Definity. We were near investors. We, had a couple of other blockchains that were smaller and didn't quite achieve the same market capitalization. We were early investors in Tezos, which was trying to put a thesis that governance was really important to these early networks. Um, and all of those investments, by virtue of being early, were very, very, very successful. I think later on, the game became much more diversified. We started to see blockchain technology being applied to finance at the end of 2019. We started to see blockchain technology be applied to, digital collectibles and trading in the form of NFTs in 2020 and 2021. And really, there's been a proliferation of use cases since then. But those early days were really about the fundamental blockchain technology.
Yeah, and I think listeners should probably realize already, but a lot of this is like how Silicon Valley operates in terms of there's a category and there's an idea, and people try new technologies, and 9 out of 10 of them fail. And I think that's the case with blockchain projects as well, with the difference that blockchain, as I've remarked before, projects never die. I sort of think the ecosystem would be healthier if they did, but there's always sort of a cohort on social media who will pump it up one more time, and they don't. It just never really goes away, which I don't think is the best outcome, but that's just how it goes. But one reason I want to have you on the show, Jake, is just sort of for our retail investors out there. How do you assess a project and not get burned by it? Because I've seen it time and time again. There's a lot of hype, and they're going to announce this and that, but a lot of it's just driven by narrative. And they'll sort of a milestone or an apparent milestone is achieved, people cash out, and then people just kind of spend a lot of time going to conferences, never work to really bring it to market. Or in the worst case, it's an outright rug pull and scam where they hype it and they just vanish. So what do you look at? I mean, I've heard of total value locked in the blockchain. The one I like is how many active developers does it have? But for people out there just kind of dipping their toes in this, what would you tell them to look at, and what are some red flags to stay away from?
Look, I think if you're just a new participant just entering the space, it is absolutely uh, much safer to stick with the big names. You're not going to go wrong if you are investing in Bitcoin, investing in Ethereum. These are projects that have been around for over 10 years at this point. They have very well established communities, ecosystems. Of course, there's questions around how they're going to do, will they succeed in the future, etc. But these are very well established communities of founders, investors, developers, and so forth. What to watch out for is early stage projects. Like at CoinFund, we try to create a very institutional firm. We have a very diligent process of evaluating companies. This means, definitely getting to know the founders, not just on Zoom, but in real life. It's really understanding how they fit into our thesis about how blockchain technology will develop and grow. It's about talking to their customers, talking to their references, really making sure that we're investing in founders that are long-term oriented, mission-driven, and have a product that long-term should be valuable. It should create an opportunity to make real returns. Not everything in blockchain is like that. There's a lot of projects tend to try to sell quick wins, and those are the ones to be wary of, I would say.
Yeah, and other sort of red flags, like is there sort of data you can look for? I think the founders are a good element. Are they reputable? And some cases, sorry for my tangent, but part of crypto and blockchain culture is pseudonymous founders and some of these people are hardcore, sincere privacy hawks who just don't want their name out there and believe in decentralization. They want to launch it and not be known. And I think that can be legitimate, but it's also sort of a mask. It's a great way to operate too if you're a crook. Is that something you've ever encountered?
It's absolutely something I've encountered. I've encountered founders who, wish to be like absolutely anonymous. I've also encountered founders who prefer to be publicly anonymous, but would reveal their identities, just to their investors. So there's a gamut. And then of course there's like normal folks who, who put their name on their public social media as well. I will say that, from our perspective, we've never like had to invest in something that had a purely anonymous founder. We never found a project where, it was so important to invest in it that we should have taken that risk on founder anonymity. And so we just haven't done that.
And I think that's good advice for retail investors out there too. If you can't identify who's running the project, you should probably stay away. I got to ask you one tough one here, Jake, which is there was some pretty salty back and forth a couple of years ago between Jack Dorsey, the founder of Twitter, who's a Bitcoin guy, and I believe Mark Andreessen. Dorsey's argument was the VCs, venture capital firms, get early access, grab a big pool of them, and then dump it on the market for retail investors to come and they're the ones who kind of get hosed. But I suppose it's the same way with public companies too. Employees get a bunch of shares, they cash out after the IPO. But do you think that's a fair criticism? And for retail investors out there, how would you sort of assess that? You can sort of look at lockup periods, or is that something we still have to be aware of out there?
Look, Jeff, I mean, I wasn't born a VC, and I certainly didn't study VC in school. I studied technology. And I think I've also had a as a earlier in my career as a tech founder, I had some healthy skepticism about VCs. Now that I've worked as an investor for 10 years, I think, and especially in crypto, I think I appreciate the role of the venture capitalist a little bit more. A lot of people have, for example, in crypto made the argument that like, well, because we have this type of public capital formation, like an ICO, like a crowdfunding, oh, we don't need investors anymore. But what I've come to learn over the last 10 years is that it's really not about the money. It's money, especially in crypto, is sort of the cheapest resource that a founder can obtain. But what they really need is to build an organization, a company, to have company building support, to have advice, to have people to rely on in difficult times or emergencies. And when I think about like how CoinFund adds values to its portfolio, well, certainly money as a capital investment is an aspect of it, but it's by far not the most important one. So when I hear skepticism of these token supplies that have venture capitalists, I understand that skepticism, but I also think that if these token supplies raised from purely crypto investors out there, they would have much less prospects for success, much less prospects for growing their company. I like to remind founders, like, guys, we're not exactly building blockchains. We're building organizations that build blockchains, and that's a slightly, more complicated problem in a way. So I also understand the other side of that. I think there have been, times in the markets where markets have been exuberant early on. Founders and investors just take like very, very short vesting schedules. I remember like in the ICO era of 2017, sometimes founders would just take a year, and when that year would elapse, they would kind of leave the project. And I don't think that forms a good set of incentives either. I don't think overselling your token supply to investors necessarily solves every problem that a startup or product faces before it could achieve success. So, I would say like every project has to be considered on a facts and circumstances case by case basis to really understand what is the right ratio of those things. But I'm not wary of investors coming together and helping to build great companies, great technologies, and great teams.
Yeah, and as someone who's covered venture capital in Silicon Valley for a long time in the conventional tech space, I think VCs, good firms really can add value because you're right. I think there's a myth of the solo hero is going to do it all themselves, but businesses don't work that way. People don't work that way. And the value of VCs, from what I've seen, are the networks they provide, the sort of the coaching, the support, I think VCs can add a lot of value and credibility too. I think CoinFund or a firm like yours comes in and touches a project. I think it's a signal that, hey, there's probably something legitimate here. So just want to put that out there too. I'm not entirely skeptical of VCs there, but overall, it's an interesting category. Jake, I just want to say thank you, as taking your time to share your expertise and, to you and your firm for being really credible, reputable actors in the space, I think, who have helped mainstream the industry and set a path for others to follow. So thanks for your time, Jake.
Our pleasure, Jeff, and thank you so much for the invite to the show.
Leo, after that chat with Jake, did that change your mind? Are you now more willing to invest in crypto than you were before?
I'm putting all my money in a Fartcoin.
There you go. I knew you'd come around. No, I thought it was insightful. I do think I like the idea you can have sort of a methodology, and there are some sort of concrete ways to figure out what you're doing. But again, I think in the same way, most people aren't professional investors. If you put money into stocks, there are people who go out there and study these companies deeply and put their money there. But I think with crypto, realistically, if you're planning to go pro as a crypto investor, I think listening to Jake would be a great thing to do. But I think for some of our, more casual people, I think some of the names he dropped were pretty helpful. What would you do, Leo? Seriously, if you had to put half your money in crypto, where would you put it?
Well, it's always a complaint that I think traditional financial people have of crypto, where there's a ton of transparency into what projects are and what they're supposed to do and who owns what, but there's not the same sort of metrics that you could look at with traditional companies, the different earnings metrics or cash flow or benchmarks like that. So it's hard to sort of analyze projects the way you would a public company if you're investing in it. I think you have to look at it based on the types of projects that are being built on top of it, sort of what the pitch is by the founders behind it. And again, I think if you're actually looking at utility, you have to look at the blockchains where interesting activity is happening. So ones like Ethereum or Solana, which is increasingly being embraced by Wall Street. But at the end of the day, I still feel like Bitcoin has always the most convincing pitch and has for its history, which really started in 2008. And of course, the market likes it because of that. What do you think, Jeff?
Well, my goodness, Leo, you sound like a Bitcoin maxi. This is a new development. No, I think you're right. Bitcoin, of course, is the granddaddy of them all. However, the price is baked in. So as you do with stocks, if you're looking for upside, you want something that's got potential to grow. If you are playing this game, you want to go in there. So I think it's good to look at that. But your point too on conventional metrics of earnings guidance, profits forecast, EBITDA, and stuff like that. But one thing that's occurred to me when you were saying that is, since it's such a new asset class, it just doesn't line up, on all fours with like the conventional metrics as well. It's sort of like going from horses to cars in the sense that, you're evaluating an automobile. You're not necessarily going to look at its mouth or look at its like forelocks or hoofs or something like that. It's a crude analogy, but I'm just saying when you're evaluating projects within a new category of investment, you're not going to look at it the same way as you would a previous one. That said, you do want to have some common sense and so on. But anyways, it's as they say, our least favorite cliche, early innings. It's not early innings for crypto, but I think for crypto investing, so we figure out sort of a systemic, rational way to do it. It's becoming clearer. Well, that's a wrap, everyone. Thanks for tuning in. I'm Jeff John Roberts, the finance editor at Fortune Magazine.
And I'm Leo Schwartz. See you next time.
This was the Crypto Playbook, a podcast by Fortune Magazine.
This episode was produced by Jalon Ursoy and edited by Ellen Estev. Art direction by Ariel Ray. Fortune's executive producer is Lydia Randall. Head of video is Adam Bannicky.
Thanks for tuning in, and we'll see you next time.